There is one simple, almost boring investment that quietly beats most professional Wall Street experts over time. And you can buy it in about 5 minutes. No stock picking, no watching charts all day, no genius required. Just a quiet little fund that has made everyday people wealthy for decades. Let us break it down. And you do not need to be rich to begin. Many funds let you start with a small amount, and some let you buy a fraction of a share for just a few dollars. So what is an index fund? Picture a basket. Instead of holding one company, this basket holds tiny pieces of hundreds or even thousands of companies all at once. When you buy one share of an index fund, you instantly own a sliver of every company inside it. One simple purchase, and you own a piece of the whole market. An index is just a list that tracks a chunk of the market. A famous one holds 500 of the biggest companies in America. The fund simply mirrors that whole list. Here's the simplest way to think about it. Picking a single stock is like betting on one horse to win. An index fund is like betting on the entire race. Some companies will fail, others will boom. But the whole market over the long run has trended upward. You stop gambling on winners and simply own them all. And you do not have to guess which companies will be the next big winners. By owning all of them, you automatically hold tomorrow's giants before anyone knows which ones they are. Now here's the part that shocks people. Over the long run, the large majority of professional fund managers fail to beat a simple index fund. The experts lose to the boring basket. These are highly paid people with teams, computers, and fancy research. And still, most of them cannot consistently beat the market average year after year. How is that possible? Two big reasons. The first is fees. Active managers charge high fees for all that effort, and those fees eat directly into your returns. The second is that nobody can reliably predict the market. Even the pros guess wrong, buy high, sell low, and miss the best days. The market humbles almost everyone. Studies that track this have found that over long stretches, something like 9 out of 10 active funds fall behind their index. The boring basket quietly wins again and again. Index funds flip both of those. Because the fund just copies a list, there is no expensive team to pay. So the fees are tiny, often a few cents per $100. And remember compound interest. A small fee difference, compounded over decades, can quietly cost you tens of thousands of dollars. Low fees are like a permanent head start. Index funds also hand you something powerful for free: diversification. Since you own hundreds of companies, no single one of them can sink you. If you bet everything on one stock and it crashes, you can lose it all. If one company in your index fund crashes, it is just a tiny ripple in a huge pool. This is why experts call diversification the only free lunch in investing. You lower your risk without lowering your expected return. An index fund hands it to you automatically. Do not just take my word for it. Take Warren Buffett, one of the greatest investors alive. He made a famous $1 million bet to prove this exact point. He bet that a simple index fund would beat a group of high-powered hedge fund managers over 10 years. 10 years later, the boring index fund won. And it was not even close. The best part might be the simplicity. There is no stock to research, no charts to watch, no news to panic over. You buy it, you hold it, and you live your life. You are not trying to be a genius. You are simply capturing the long-term growth of the entire economy, automatically, while you focus on everything else. You will hear two names: index mutual funds and index ETFs. Do not overthink it. Both can track the same index. The main difference is just how you buy and trade them. An ETF trades like a stock during the day and often needs only the price of one share. A mutual fund settles once a day. For most beginners, either one works perfectly. Now, let's be honest about the risks, because index funds are not magic. The market does go down, sometimes sharply, and your balance will drop in bad years. But historically, the broad market has always recovered and gone on to new highs, given enough time. The key word is time. This is a long game, not a quick flip. The biggest mistake is panic selling when the market drops. Selling in a crash locks in your losses. The index investors who win simply hold on and keep buying. And remember, you get the market return, not a magic jackpot. Index funds will not double your money overnight. They build real wealth slowly, steadily, and reliably. There is also a simple habit that pairs perfectly with index funds: investing the same amount every month, no matter what the market is doing. It is called dollar cost averaging. When prices drop, your fixed amount simply buys more shares on sale. Over time, this smooths out the bumps and takes all the stressful guesswork out of when to buy. So how do you actually start? Step 1. Open a brokerage or retirement account. It is free and takes just a few minutes online. Step 2. Find a broad, low-cost index fund. A total market fund or a big 500 company fund are classic, simple choices that own a huge slice of the economy. Step 3. Check that the fee, called the expense ratio, is nice and low. A tiny number here means more of your money stays invested and working for you. Step 4. Set up automatic monthly investing and then leave it alone. Buy in good times and bad, let it compound, and resist the urge to tinker. That is really the whole secret. Boring, consistent, automatic. The people who win with index funds are not the smartest. They are the most patient. Let us recap. An index fund is a basket that owns a piece of hundreds of companies at once. It beats most experts because of tiny fees and built-in diversification. It is simple, it is hands-off, and over the long run, it has quietly built more wealth for ordinary people than almost any complicated strategy ever has. You do not need to beat the market. You just need to own it, keep your fees low, and give it time. That boring little basket might be the smartest move you ever make. So now I want to hear from you. Have you bought your first index fund yet? Or is today the day you finally start? Drop it in the comments below. If this finally made index funds make sense, hit that like button, subscribe for more simple money lessons, and share it with someone who is afraid to start investing.